first panel is dealing with capital markets and post-trade services. Obviously, a big chunk of the financial services in Europe. Our speakers are Rick Watson, who's Managing Director at AFME and Head of Capital Markets, Kevin Arnold, Managing Director and Head of Relationship Management at UBS, Michael Collins, Chief Executive of Invest Europe, Eric Lidvack from Société Générale, who is also Chair of ISDA, and James Cunningham, who's Senior Advisor, European Regulatory and Market Initiatives, Bank of New York Mellon. Many topics to address in terms of capital markets and post-trade services. I will ask Rick Watson to kick off, and I think the timing is particularly topical, given what AFME and BCG came out with precisely today. So Rick, if you want to start, and then we'll continue the discussion.
Perfect. Thank you very much, Thierry. And AFME is delighted to be here today. And it happens to be very good timing because the AFME Board of Directors over the last few years has been very focused on how the wholesale capital markets, which our association represents, can assist real economic growth across various sectors. And a few months ago, we commissioned Boston Consulting Group to do exactly that. And we asked them to do two things, specifically to focus on and meet with and speak to large corporates, investors of all different types, as well as SMEs across Europe in various countries, in various industries of various sizes, to really ask them directly, how will Brexit impact you at all? And if so, exactly how? And there's very interesting results that are included in a report you'll find at the front table, which we're announcing today. And in terms of how we worked with BCG, we formed a working group, and my colleague Kevin Arnold from UBS, he runs investor-client relationships there. We have a working group of members who deal with clients who are involved with the real economy, the buy side, large corporates, and small companies, as well as the research side of our members. And we've worked over the last few months to really put together detailed questionnaires for the interviews that BCG conducted on their own. So the results that you see in this report are directly from the end users. They're not from the banks, they're from the end users. What we then did next is ask, based upon the results of those interviews, are the expectations of the end users realistic, and are there any disconnects between what the corporate investor community is thinking Brexit might have an impact on versus what those expectations are in terms of the wholesale capital markets, and are those realistic? With that, I'll turn things to Kevin to describe how the interviews were conducted, some of the feedback from the interviews from all three different sectors, and then I'll talk about some of the quantitative analysis later.
Thank you, Rick. Can I just check that everyone can hear me? So first of all, as you heard, just heard then, first of all, it's important to stress just how much time we took over the past few months. I think we started this project back in October. Just how much time was spent in the initial stages defining and identifying just who it was we were going to approach. Because as every statistician knows, your sample set is key to the outcome and the results of a good survey. So we spent a lot of time in our individual groups, and we split up into teams looking at SMEs. And the definition for SME was any corporate in Europe with a turnover below 250 million euros a year. So we looked at SMEs, then we looked at large corporates, which by nature was above 250 million euros. Then we looked at the investor class, which included the whole broad array of investors, insurance companies, asset management companies, hedge funds, private equity, venture capital. And then in our separate groups, we began to look at just who or who was not relevant for the purposes of this. And I think when you look through the report, you'll see that what we've tried to achieve here, and what we have achieved, I believe, is a very, very representative study of both EU 27 and UK currently domiciled investors and corporates that have a real interest in the outcome of the Brexit discussions and negotiations. And as you'll see from the survey, whose businesses are at significant risk for a result that basically is not in their interests. So in terms of the representation, it's worth noting, so of the SMEs, they represented 23% of the survey, large corporates 43%, and investors, as broadly defined across the asset classes, 34%, 52% of which were based in the EU27, and 48% currently based in the UK. And we looked across every sector, so basically telecoms, pharmaceuticals, industrials, automotives, and then basically also the trade associations covering them. And you'll see one of the SME trade associations we looked at covers 11 million different corporates within Europe. So very, very representative, very, very detailed. And then obviously, to the extent we were then able to identify the population we were looking at, we spent a lot of time with BCG working on case studies and questions that would not only present the threats and the risks as we saw them, but would also hopefully solicit some really interesting interviews and some proper feedback during the course of those interviews, which then BCG went out and conducted on our behalf. They were all done basically bilaterally. None of the banks that were involved in putting the questions together were present at those interviews, and BCG conducted them on behalf of AFME. And all of the banks involved were working on behalf of AFME as well, not in their own sphere. So hopefully that sets out what it was we looked to try and do in terms of putting the survey together. And then the findings were particularly interesting. I think everyone's got the survey in front of them. But the findings were, first of all, I was surprised by, one, the general lack of preparedness, and also the fact that a lot of the institutions surveyed assumed that the banks and the financial intermediaries would bear a lot of the costs of Brexit, and they were being trusted to put in place structures to absorb some of the costs and absorb some of the difficulties. So that's interesting, I think, from the point of view of the level of preparedness, and also the onus and the burden that people assume would be assumed by the banks vis-a-vis their own institutions. I think that basically warrants further attention. Hopefully we can come back to that in questioning. What also was particularly noticeable was the fact that of all the people surveyed, it was the SMEs that were most concerned about the financial costs and about their ability to access both wholesale banking services after the resolution, after Brexit, and also the cost of accessing any services they may still have access to. So basically they thought they would be segmented out in terms of focus, and also they thought that they would, an inordinate amount of the costs of restructuring and of repapering would fall upon them. So that, I think, is in broad terms. But in terms of the case studies were set up as well to cover both people from the EU looking into the UK and from the UK looking out into the EU at both a corporate and an asset management level. So we looked at costs of banking services, costs of hedging transactions, access to treasury and foreign exchange markets, ability to distribute product into the UK and into Europe, depending on which side of the current channel you currently sit on, and also cost of marketing, ability to market, and ability to raise funds. So I think in terms of the overall situation that people are faced with, I think we did a pretty exhaustive job at looking at the possible permutations from both sides of the situation. And hopefully you'll find the survey interesting from that perspective.
Rick, do you want to dig further into the survey itself?
Yes, thank you. What we asked BCG to do next, and one thing I also wanted to do is thank Clifford Chance for their active participation in the report, because what we in BCG really want to do is make sure that we had a really firm grip on exactly what the legal constraints and legal changes would be post-Brexit. And what one of the main issues is, realities is, in many cases, banking licenses aren't necessarily all in the right place post-Brexit. And as the report we'll go through some figures in a minute. In certain market services, there's a lot of the services provided through London. In other cases, there are not. So what we asked BCG to do, particularly with the focus on on economic growth is to look behind the front office curtain that clients will generally see. They have a relationship officer, generally with a commercial bank or a wholesale bank, that will provide a menu of services to any particular client. We asked BCG to say, okay, if you look behind the front office curtain and look at the plumbing and infrastructure behind what's required for a commercial or investment bank to provide those services, what changes post-Brexit? And broadly, we asked BCG to do three things in terms of figures. And this is basically to evaluate, based upon what Kevin mentioned, in terms of, particularly from the large corporates and the investors, and particularly, we're really happy Michael's here today. He can go to some more detail from the buy side. The large corporates all have many banking relationships, both commercial banking and investment banking relationships. And so when BCG heard from them almost universally that there'd be very little impact from their perspective in terms of cash pooling, cash management, and banking services, that really wasn't a surprise to us. But they did say they're expecting the banks to absorb costs and keep things as business as usual. So when we asked BCG to look behind the curtain, we're trying to basically assess whether that's a realistic and valid assumption, because it's a really important assumption. We actually heard the same thing from the large buy side. Because both with large corporates and the major buy-side firms surveyed, three-quarters of them, two-thirds to three-quarters of them, all have very high numbers of banking relationships, so there's a lot more competition, which gets back to the theme of the SMEs, since they generally maybe only have one. I think 60% of SMEs only have one banking relationship. There's a lot more issues involved with the SMEs. The first thing we asked BCG to calculate was, is the capital in the right place? With respect to banking licenses. And one of their conclusions was for banks to be able to provide the same amount of services post-Brexit as they do now, there will need to be a total of 70 billion of Tier 1 capital moved from out of the UK-based institutions. Now, this includes subsidiaries. This is not just the big four UK banks. This is all banks that basically do business, and particularly from the lending and markets perspective, with EU27 clients. 70 billion of Tier 1 capital, 140 billion of including Tier 2 capital, will have to be moved, in the worst case, in the case of a hard Brexit, from the UK to the EU27. And that's a movement of capital that will, and you can imagine how many contracts are connected with the assets associated with that capital. So that's one of the key recommendations and findings that are the grandfathering contracts is really important. Because if you look at this, the magnitude of cash and assets that need to be moved, it's about 1.1 trillion euros of loans and securities that will need to be moved from the UK to the EU27. The next thing we asked them to calculate was, what are the costs of moving that, the people, the capital, and also what's the ongoing permanent capital that will be required to be held in a more fragmented post-Brexit environment? Because getting, again, back to the banking license issue, banks which are currently using passporting out of the UK will need to set up, if they don't already have set up, subsidiaries, not branches, subsidiaries, which is much more complex and costly in the EU27. Now, some institutions already have major banks inside the EU27, some don't. And so what this report tries to look at is in aggregate what's going on within the commercial and wholesale banking side of things. BCG concluded that the cost of moving the people, setting up the infrastructure, the compliance system, the risk management systems is going to be about 15 billion euros. The amount of additional permanent capital that will have to be there to absorb the costs of additional, what's the right word? Friction's not really the right word. It's basically overlap between functions that currently take place in the UK, which probably will still be there after Brexit, but additional, for example, risk management and companies that will need to be set up inside the EU27, 20 billion Tier 1 capital additional, plus 40 billion of, 40 billion of including Tier 2 capital. In terms of how that's broken out between lending services and securities services, we do find there's a much bigger impact on the wholesale markets services side of things rather than lending. Of that 70 billion capital to be moved, which I mentioned before, about 13 billion of that is loans related. And that 13 billion of capital has about 180 billion of loans associated with it, which according to BCG's calculations, which are based upon publicly available ECB and EBA data, is about 4% of total loans outstanding. So it's not totally insignificant, but it's not a huge number, but it's still a reasonably decent sized number, it's a reasonably large number. On the market side of things, it's a bigger impact. There's 58 billion of capital, tier one capital, that will need to be moved, which is associated with $1.05 trillion of securities associated with that. In terms of swaps, the notional amounts, of course, will be higher. So they're pretty large numbers in terms of the whole market. So getting back again, how you get to the 70, there's 13 billion of loan-related capital and about 58 billion of markets-related capital. And of that, that amount on the market side to be moved, that represents about 68%. The EU27 clients represent about 68% of the total EU28 pot, or about 47% globally. So for example, total markets business done out of London at the moment, 47% is connected to EU27 clients, and again, about 68% of it if you just look within the total EU28 as it stands. The third set of figures we asked them to calculate was the impact if euro clearing needed to be moved within the EU28 and split out from where much of it currently takes place in London. And the BCG concluded there's going to be roughly 30 to 40 billion euros of additional collateral, not capital, but collateral required, plus an additional 3 to 4 billion euros of contributions to the CCP default fund. There's about $1 billion of additional capital required to support that collateral. However, that figure could be much higher if compression benefits aren't agreed in any type of Brexit negotiation. So that, in terms of the capital figure, in terms of the movement of collateral, that figure is not really nailed down. The last figure we asked them to calculate was, what does this mean to the bank's business in terms of business models? And I think that's one of the key things that we'd like to emphasize, is Brexit will cause fragmentation. There's no question about that, because many banks using UK-focused passports will need to set up subsidiaries. The question is, what do the business models of the various banks look like after Brexit? In some cases, they probably won't change. Some cases, they may change quite a bit. But again, that's, I think, one of the benefits of the BCG approach is they looked at the industry in aggregate. If you look at that 15 billion of costs amortized over 3 to 5 years, that will reduce ROE in aggregate of the industry somewhere between 0.5% to 0.75% per year, which for some institutions is material. So one of the questions that comes up, and again, I think it filters back and is consistent with the SME's concerns, is what do post-Brexit the business models of the different banks look like, and how is that going to impact their client lists, their business models, and that type of thing. I think on an individual basis, it is certainly up to the banks to decide what their business models look like, which kind of clients they target, but there will be certainly some changes post-Brexit. With that, I'll stop.
Many thanks, Rick. I have so many questions I would like to ask you, but before I start doing that, I'm going to ask Michael to give his view of the issue. And as we know, and that's one of the big questions I will ask you after, is looking at the situation from the financial industry's point of view is indispensable, but what about the other side of the equation? Yes, SMEs are worried, they're concerned. Is their concern founded? Or is it like, I'm worried, but life will go on? And so, Michael, what's your view on the impact of Brexit on the ability of the European economy to finance itself and access the services it needs?
Thanks, Jerry, and I'm grateful to Institut Friedland and to AFME for the BCG report, which we were very pleased to be able to participate in, because this debate, this look forward to what the world will look like potentially as soon as March 2019 is essential for our industry. For those of you that don't know Invest Europe, we're the trade association that represents the private equity and venture capital industry in Europe, both the fund managers and the institutional investors that provide the underlying capital that can be invested into European businesses. Whenever I sit on a panel of this sort with Rick, I always feel like the poor relation, because the size of our industry is dwarfed by what goes on in the banking sector. Invest Europe members, the private equity venture capital industry in general in Europe, is investing around about 50 billion euros a year into 6,000 companies. But what's important about that investment is not the size, but the types of company that are being backed. Of those 6,000 companies, well over 80% of them are SMEs. And those that are being backed by venture capital are, I think, the ones that are particularly interesting for this debate, because they are the companies that we anticipate and hope will become the growth companies of tomorrow and the European, if not global, champions thereafter. So even if the sums are relatively small, this is a really important part of the funding escalator that the Commission likes to talk about in the context of CMU. And ours is an industry that over the course of the last 20, 25 years has become increasingly cross-border, not just cross-border in Europe, but increasingly global. If you go back to the early 90s, when European private equity and venture capital was probably only raising a handful of billions a year to invest, most of that, 70% of it, was being raised locally. So fund managers, venture capitalists, private equity managers in one country were raising most of their money from investors in that country. You take that forward to 2016, the most recent year for which we've got data, and it's completely flipped. Now most of the money is being raised cross-border, not only here in Europe, but globally. 40% of the 74 billion that was raised by our industry last year came from outside Europe. So we're now an industry that's very, very used to operating in a cross-border basis. And Brexit, almost by definition, introduces new costs and introduces new barriers to that kind of activity. As with many of the industries that, and many of the aspects of financial services that Rick's already mentioned, the UK is very much the heart of private equity and VC in Europe. Well over 50% of the assets under management are managed from the UK. But what you see in our industry is what I would refer to as a kind of recycling of capital. UK fund managers raise a good chunk of their capital, around about 20% a year, from investors in the EU27. Pension funds in the Netherlands, insurance companies in Germany, family offices in France. But that money doesn't sit in the UK, it doesn't stay in the UK. Those UK-based fund managers, whether they be VC or private equity, are then putting that money back to work into small businesses in the rest of Europe. So if you look at private equity and venture capital investment in the EU27, around about a third of that actually comes from UK-based managers. So you have this recycling effect in which a pension fund or an insurance company in the Netherlands or Germany is placing that money with a UK-based manager because they believe that manager is the best equipped, the most successful, got the best team. Not because they want necessarily to be backing UK-based SMEs, but because that manager will be the best placed to make the returns, to find the good investment opportunities. So if you look at our industry, it's now, as I say, become incredibly cross-border. And Brexit, whether it be for fundraising, whether it be for fund management, whether it be for investing, or whether it be at the stage of exit, Brexit has the potential to introduce all kinds of barriers and costs and frictions that will make the lives of my members more difficult. As we get on, I can get into a little bit more detail, Thierry, about what those particular barriers might be. But our plea, our call as an industry is to ensure that those additional costs, those additional burdens are at the absolute minimum. Because if we don't reduce those costs to the absolute minimum, what we will find is that we get a less efficient allocation of capital. And what really worries us is that what we will find is investors will simply decide to look elsewhere. They'll simply decide that Europe has become too complex, too costly, too burdensome, and they will look to the US, they will look to Asia, which is a growing market for private equity and venture capital. And those 6,000 SMEs, high growth potential SMEs that are being backed by our members every year, will be the ones that ultimately lose out on the investment that they need.
Thank you, Michael. Same thing, many questions, but let's finish the first round and then we'll get the debate going. Eric, do you want to give us your view? Eric, you're very much you're one of the best specialists, of the derivatives industry, and therefore, you're the chair of ISDA, which is, what we know. So your voice is obviously authorized, I would say. So obviously, the hedging dimension or the impact of Brexit on the ability of European corporates to hedge their risks is a fundamental issue. I was referring in my introduction to prominent voices who said, we're facing major disruptions. We heard Mark Carney, Governor of Bank of England, when was it, 6 months ago or 4 months ago, say, hey, we have an issue there. What's your view on that? This is absolutely fundamental. How do you see things as the chair of ISDA? And obviously, there's many other issues on clearing and a number of regulatory issues that we want to discuss as well. But I'd love to kick you off on this one.
Thanks, Thierry. So a few high-level thoughts, and obviously we can dig into all of those more deeply during the open question and answer session. The topics I wanted to touch on briefly in terms of high-level remarks were the impacts on contracts, the impacts on capital and industry capacity, and then perhaps more specifically the specific pain points that we might see post-Brexit and that might require more attention during any transition phase. And the way that we look at the issue is really, well, as we move forward into Brexit, we have this whole debate over what Brexit means for our industry, for our contracts. Beyond the platitudes of Brexit means Brexit. I mean, as you said earlier in your opening remarks, Brexit certainly means a loss of passporting. It almost certainly means an uncertain equivalence or recognition environment for the existing cross-border statuses, whether they refer to the MiFID equivalents, the banking regime under CRD4, the impacts on BRRD, the Recovery and Resolution Directive, and the vast impacts on EMIR. All of these play out on the derivatives industry in different parts of the value chain, and all of them will be in some way open to interruption by the change of the legal framework. And it's important for financial services providers to have a clear view on that now, even though we know that a number of the questions that we're asking now won't be answered until 2019. But effectively, what that means for financial service providers is that really Brexit is now for most of the financial services intermediaries. 2018 will be the year of Brexit preparation. And if you don't know that, then the FCA and the ECB are behind our backs telling us that we should be thinking about it that way. And they're very keen on finding out exactly what we're thinking about in very minute details about very specific aspects of how we're rethinking our booking models, how we're thinking our operational models, how we're rethinking our contractual risks. And really that will replay the whole way that the financial services providers act out in the European profile. And this is some of the aspects that Rick was alluding to. I mentioned we at ISDA looked first at contracts in the context of how do we look at Brexit and what communication do we give to our members and to users of derivatives, because there are some very real open questions. What will, if you have an existing derivatives contractual relationship, what will Brexit do to that? Does it create a termination event? Does it create, under your master agreement, does it create a force majeure event, illegality, impossibility? Is there some sort of breach of representation? We've gone through all of those issues, and I'll just put a little plug. We have an FAQ section on our website under www.isda.org Brexit FAQs that walks you through each of those scenarios. The positive angle is that in most respects, the master agreement should be robust to Brexit. So for clients who are using derivatives at the moment, there shouldn't be a rupture of the existing contractual relations, and that's extraordinarily important. However, as Rick certainly was alluding to, and as Kevin was alluding to, the reorganization of the providers of financial services as the existing European landscape becomes a cross-border landscape, at least with respect to the UK, means that there will be probably new subsidiaries to be created within the EU 27, and that means repapering new contracts, new relationships, and that in itself will be a significant burden. We also need to look carefully at what the impacts are and what the paths to remediation are for different banks. Rick alluded to the additional capital that will be required to back up the new subsidiaries and the significant exposures they would have to their counterparties in the EU 27. That in itself changes the way that you look at relationships, specifically with respect to markets and derivatives. There will be probably some sort of capacity reallocation. You asked about whether there's a cliff edge effect with respect to this. The way I like to think about this is we have some financial services that are distributed. They're provided by multiple participants in the market to multiple clients. And those services will probably not be subject to a cliff effect, but they will be subject to some sort of capacity constraints because there will be actors who have a very significant load in order to be functional on Brexit day one, and they may not be entirely ready there. Certainly, actors who are currently present in the EU 27 should be able to provide a seamless continuity of service to their clients. Actors who are using London as their primary platform for access to the single market have a more significant lift to get there. And so whether it's due to time constraints or capital constraints, you would imagine that a certain amount of the existing London-based capacity will take time to reestablish itself in Europe. So for those distributed services, what I would project is that I don't see a cliff effect in terms of availability of capacity to EU corporates, EU SMEs, EU investors, but I think there will be a certain amount of supply and demand readjustment and capital constraints, simply because the world is changing. The world is less efficient. The European financial services market will be less efficient, and it will take time to readjust. And it may well be that a certain number of actors will reallocate their capital regionally. I would expect that EU-based actors would probably reallocate a certain amount of their capital back towards Europe if they consider that there is a shift in capacity constraints. I would expect a certain amount of London-centric actors might, during a transitional phase, shift more of their capital elsewhere because they may simply feel that the risk-reward on their capital allocation shifts that way. So, broadly speaking, for distributed banking services, I think not a real cliff effect, but some reallocation of capital and market share. Then the other issue we need to look at is where do financial services go through a single point? So typically, if to the extent that financial services go through a clearinghouse, then you have a single point where the transition becomes tricky to manage. And I think we can go more into the issue of CCPs later in the discussion. You may also have similar issues around benchmark providers, which are again, oligopoly providers and where you do need to manage that transition. I think you may have issues around access to CLS for payment versus payment settlement. So where we look at transitional measures, and I do think there will be a call for transitional measures, but I'm less optimistic than some in terms of how broad those will be. I think they will need to be very targeted in order to address those issues that are very specifically at risk of some sort of cliff edge disruption. In terms of how we look at CCPs, I think you need to be a little bit more discriminating than perhaps some of the public debate has been. I think there are some very real concerns on both sides of that debate, and that we probably need to look at the issue differently, considering whether you're talking about CCPs that clear securities versus term contracts. Within term contracts, potentially you could look at repos differently from long-term over-the-counter derivatives. And there are significant questions over loss of efficiency if you break up netting sets. There are significant questions over the increase in default resources that breaking up netting sets would require, and the very significant operational workload that would be caused by a migration of a clearinghouse exposure. So I'm going to close there because I think there's a lot of questions. High-level message is that master agreements should be robust to the transition, but there will be some repapering required. We would expect some capacity constraints over the market rather than actual disruptions, but then specific areas will require a focus of attention to avoid disruption around CCPs notably, maybe some other areas, and will require some targeted and probably unilateral relief. And I stress the issue of unilateral relief because there is a very real risk in the negotiation process that we don't get to an accord, and it will be very important to look at where can relief be provided without the context of an agreement, where can it be provided on a unilateral basis, and I'll close there.
Many thanks, Eric. Very interesting. Obviously, we'll come back on that central clearing issue, which is such a big issue, and we'll ask James in a minute to share his view on this. You know, as a great specialist of post-trade services, perhaps to put this in perspective, and that's one thing we highlight in the report that Institut Friedland put out today. And actually, it's exactly the same number. It's reassuring. In the BCG AFME report, the outstanding notional of euro-denominated derivatives contracts cleared in London is today standing at 83 trillion. That's 83,000 billion euros. And that's more or less 10 times European GDP. So if you look at the situation from an efficiency point of view, this is a very efficient way of working because obviously in terms of cross-margining and efficiency of, you know, putting up as little collateral as possible, which is obviously good for the financial industry, there's no doubt that it's efficient. But the other question is it resilient? And we all know that in ecosystems, efficiency doesn't always go with resilience. And European regulators, and when I say European, I mean EU regulators, are currently looking at the situation, it's a well-known fact, from a resilience point of view. What happens if there is an accident? Do we have a problem for financial stability? Do we have a problem for monetary policy transmission? I'm not going to close the subject now, but it's important, and I really appreciate what Eric said in saying, you know, we have to put things in perspective, and there are very valid arguments on both sides. And, you know, just to summarize, in my view, it's efficiency versus resilience, and we have to strike the right balance, which is not struck at this moment, but it's important that we all together have at least the right ingredients to put into the debate, which is going to last for quite a number of months. James, your turn to share your views on these topics.
Great, thank you very much, Thierry, and thank you to Institut Friedland and to AFME for being able to speak today. Thierry, in your introductory comments, you make a very interesting distinction between efficiency and resilience. I think this whole topic of Brexit is a very large topic. Clearly, within that topic, you know, problems or the trade-off between efficiency and resilience is one, perhaps fairly detailed element within that broad context. I would probably argue that in reality there is not such a trade-off, that in fact, if you have efficiency, then very often you also do have resilience, but I'm sure we'll come back to that topic because this is probably at the heart of the euro clearing discussion. What I would like to do before we get into the detail is really just to make some introductory comments, both about, as it were, BNY Mellon itself, and just a couple of words of introduction about BNY Mellon. So I work for BNY Mellon, the world's largest global custodian. I think we're interested in this debate partly because we have a major presence in London, like many other major players, but we also have a major presence in the EU27 and a major bank located in Belgium. In fact, we're the 5th largest Belgian bank. So I think if you look at this Brexit debate, we're very well placed to see the debate from both sides. One overarching comment, clearly, from our business perspective and the business of providing services to capital market participants, we have an overriding interest in having, as it were, I won't say efficiency in markets, but in order for markets and for participants, capital markets participants, to have access to markets for the trading process, for the post-trading process to work efficiently as possible. And I think, essentially we're plumbers and we want the plumbing to work. And I think that's our key driver. In that context, and as many of the speakers have previously mentioned, Brexit does create challenges. So I think we're faced with the challenge of how to manage this Brexit event. Just a side thought that comes to mind, thinking of the today's headline of the Financial Times. The headline of today's Financial Times is Brexit related, so I thought, as I was arriving this morning, this is a very timely event. What I think when we look at Brexit, we need to look first of all at the impact, and I think the AFME report is very interesting on the impact. It gives figures, and as it were, detailed figures, and it kind of justifies the figures, and it gives, as it were, the real economy connection behind those figures. I think this is very important. We can approach these topics at a very high level, very abstract level, but it's also interesting to test the reality of the high level against the individual drivers for real economy participants. And clearly, I think the aspect, as Rick mentioned, the aspect in the AFME report around SMEs is of particular interest, because very often we forget about SMEs. We think about the large corporates, the major market participants. I think impact, just a side comment about impact. Clearly, impact, we need to look both at the transition costs, but we also need to look at the long term. And the long term is, if the Brexit outcome is two separate markets, the reality of two separate markets will increase costs compared to a single market or a unified or an integrated market. I think we need to bear in mind those long-term costs. At the same time, and Thierry, this comes back to your comments about resilience and efficiency, essentially, fragmented markets are systemically more risky. Smaller fragmented markets are systemically more risky than large integrated markets. So I think this is a core element of the discussion that we need to keep in mind. However, for me, perhaps the two core questions in this whole debate, going beyond the impact, and the impact, I think, is gathering the information, the data to understand where we are currently. Two core questions are, perhaps a very Leninistic approach, what needs to be done and who needs to do it? And I think perhaps, I hope we'll come into some discussion about what needs to be done, but perhaps it's worthwhile just looking at who needs to do things. And I kind of divide up who needs to do things into three categories. The first category is, let's say, the private sector by itself. And Thierry, when I looked at your report this morning, a quick skim through your report, I noted that you were relatively optimistic that the private sector could do things, could adjust, could continue to provide services to its clients. And in good part, I agree, and I think this is what we're seeing currently. Private sector actors are adjusting in order to be able to ensure or to create the greatest possibility that they can continue to provide services, in just under 2 years to their clients at point of Brexit. So yes, absolutely, the private sector is adjusting. One critical point, I think, is the private sector can adjust where it has powers to adjust. And very often, the private sector company has the ability to adjust where it relates to its locations, its internal arrangements, its contractual arrangements with its individual clients. That is within the power of an individual private sector entity. However, there are certain arrangements where an individual private sector entity doesn't have the power. And this runs into a problem of collective action. And I think the biggest single example of a collective action problem in this area is everything to do with market infrastructure. So market infrastructure, almost by definition, is a network. Market participants access market infrastructure in order to be able to connect to other market participants. You will not connect to a piece of market infrastructure if you are the only entity using that market infrastructure. So shifting by yourself your activity from one piece of market infrastructure to another doesn't necessarily, as it were, provide any solutions. It may do under some circumstances, but not necessarily. So that's where we have, as it were, a collective action problem. Individual market participants cannot solve that problem by themselves. So they need kind of a context around in order to adjust. And I think we arrive there directly at the third critical set of actors, which are the public sector actors. So clearly in this whole Brexit debate, we are faced with, as it were, a political problem, as it were, risk caused by political decisions. That I think there's a great responsibility on the public sector actors, to deal with the public sector problems and also provide a context where entities and processes such as market infrastructure, which are heavily dependent on the regulatory environment, can adjust. So perhaps, Thierry, I'll finish there, but I'm sure there's a lot to discuss.
Many thanks. I would very much like, in the second round of questions, to push all of you on looking at the very same issue, obviously, from the client's perspective, from the enterprise perspective, and to go one step further once we've analyzed the disruptions, the cost for banks, financial services providers. Yes, there is disruption. Yes, there are costs. Impact for enterprises, corporations, whether large or SMEs. What's the impact? Is it going to be, if I were to put it in an almost simplistic format, is it going to be a blip? Okay, we have a few weeks, so it's not so nice, and after that life goes on? Or is it something more fundamental? There was a report produced by an excellent think tank in this city a few months ago that said that it would increase with Bruegel, which is a superb think tank. I have a lot of admiration for them, but they said that it would increase the cost of capital of European corporations by whatever, 10 basis points. My analysis, no pretension to be right, is that I don't see why it would, but am I right in saying that I don't see why? I'd like to push you to look at the situation from the other side's point of view. And if I want to be more specific, perhaps for Kevin and Rick, on linked to the BCG report, 2 or 3 very specific questions. Is SMEs are concerned, and as I said earlier, is that concern founded, or is it like we're worried, but it's not really founded? That's one thing. On the issue of lending, and by the way, with Wim, Chief Executive Officer of the European Banking Federation, who will give today the concluding remarks. I'm sure that Wim will address this issue. But certainly the report that Institut Friedland put out this morning, and which, as I said, has only one objective, is to put the parameters on the table and think together and debate. But one thing we highlight is that the ECB said that number is a bit different, but doesn't matter. 1% of the loans provided to EU corporates come from UK banks. That's the ECB in their report in May of this year. So 1%, 67 billion euros. the ECB says. So looking at that number, you think, okay, fine, it's not nothing. If you look at 67 billion, it's a lot of money, but 1%, fine, life goes on, and competition will do its job, and life will go on. Am I right in saying that, or am I missing something? I want you professionals to tell me on this. And one thing I'd like to challenge you perhaps on is the notion of fragmentation of markets. I tend to look at financial markets, first of all, not as there's one financial market, but there's financial markets for different financial instruments or classes of assets. That's one thing. And the other thing is, if you have a financial market for equity or for corporate bonds, or you name it, let's take corporate bonds, okay. People dealing on that particular market today are mostly based in London. It's a fact. Why would it change the quality of that market if the very same teams from the very same investment banks are based in Frankfurt or Paris tomorrow? Why would it remove the efficiency of the market? So therefore, what do we mean by fragmentation? Obviously, we all understand the word, or we think we understand the word, but what do we mean really? So that's really the three questions for you, and then I'll elaborate for more questions for Eric, Michael, and James. And, time is running, but your turn.
So Thierry, so if I can go to your first question in terms of, is it right that the SMEs should be concerned? I don't think this concern is specific to SMEs. I think it's specific to smaller players in every one of the categories we looked at. I think as you look at the post-financial crisis environment and the increased regulatory burden of banks and all players have had, an increased cost of capital, it's a natural consequence of that at every part of our client base, we look at respective size, we look at cost of sales. And a consequence of that has been that some smaller players have had their access to their previous financial counterparties either cut off or restricted somewhat. And so I think the SME concern, in the light of them being the smallest players in the market, is a real one, but not necessarily confined to the SME. So whether you're an asset manager or an insurance company or a venture capital company, whatever class of investor you sit in or player you sit in, depending on where you sit in the sort of size and revenue hierarchy of that sector, I think you're right to be worried about access to resources, which quite frankly are getting increasingly scarce, harder and more expensive to price by the service providers. And that's a real issue. In terms of fragmentation, you mentioned the word ecosystem. A strong ecosystem has been built up through interconnected institutions, nettable markets, offsettable contracts and risks. And as you break out and break apart that ecosystem, it's natural that the efficiencies involved in netting will be reduced. That has an offsetting or a detrimental impact on efficiency at a bank and a financial service at a derivatives house level, resulting in lower efficiencies of capital, and also less provision of capital. Banks have internal targets and they can allocate capital where it makes most sense for them. As you dial down the efficiencies in certain product areas, capital will be starved in those areas and move to other areas where it's more effective. So I think there are real issues really around the strength of the ecosystem, or the resilience of the ecosystem, and the codependencies of products and entities within that. So that's what I wanted to say, Rick.
Thanks. A couple of further thoughts on the SME side of things. One of the conclusions of all participants was 80% of the respondents who spoke to BCG want the status quo in terms of their commercial and investment banking relationships and costs unchanged. That's what they'd like. My concern on the SMEs are 3 points. Early this year, we published a report together with a number of other trade groups, stock exchanges, together with the EIF, on the shortage of risk capital for Europe's SMEs. And SMEs count for, this is all in the BCG report, 67% of European employment, 58% of gross value added, and of those SMEs, about 15% of EU27 SMEs export into the UK, and vice versa. 15% of UK SMEs also export back into the EU27. So the numbers aren't small. The fragmentation of Brexit is going to raise the cost of capital for SMEs anyway, irrespective of investment banking and commercial banking. It will make it more difficult for those SMEs to run their businesses due to changes in employment law, tariffs, lots of things totally unconnected to the markets. So the SMEs already have a bit of an uphill wind because of the fragmentation that will cost them, just irrespective of banking relationships. The second issue, I think, is actually a point that Michael raised, which is a really important point. When the Shorter Risk Capital Report emphasized that a key thing that Europe needs more of is risk capital to small businesses. And when you're raising small amounts of money for businesses who want to raise 10,000 euros, 100, 500,000 euros, that's far too small for a venture capitalist or private equity firm. You need to rely upon business angels and even crowdfunding networks to do that. So the key part, however, of getting those smallest investors to invest so that Michael's members can actually then make a commercial decision to invest that 10, 20, 50 million from a VC or private equity firm is whether they can actually get out of their first investment. There has to be a chain that keeps working. Because the combination of Brexit and AIFMD will make it more difficult for fund managers who do the cross-border investment of risk capital into SMEs, it will make it much more clumsy because those participants will have to rely upon national private placement regimes. In some cases, those exist, in some cases, those don't. So Brexit will then make it even, apart from commercial banking and investment banking relationships, it'll make it harder and more expensive to raise capital. So I think between those three things, I do feel that the SMEs have a reasonable cause to be concerned about certain aspects of Brexit that will make their business more difficult.
Thank you. Michael, you mentioned that situation being what it is, we're seeing barriers being raised everywhere, and that at one point, VCs and private equity investors in the UK, based in the UK, might decide, I think you used the expression, to look elsewhere. But is that going to have an impact for EU27 corporations looking to raise private equity? And is that only, I love to provoke sometimes, just only good news for EU27 venture capitalists and private equity investors, because they have less competition from their UK counterparts or colleagues or competitors? Or is there something more subtle and more difficult to look into?
Is it good news for the underlying SMEs and underlying entrepreneurs, I think is the question that we should be asking. As I said before, there's around about a third of the investment that private equity and venture capital makes into EU27 businesses currently comes from the UK industry, the UK private equity and venture capital sector. Now, we may well, if we look at this as a glass half full and we think about this optimistically, we may well conclude that EU27-based private equity and venture capital will immediately step in and be able to fill that gap if UK-based managers feel that they are no longer interested in the EU27 or no longer have access to the EU27. But that's quite a big assumption to make, and that is billions of euros of investment into small businesses. Many of them, as I said, are the kind of high-growth potential businesses that we hope will be the champions of tomorrow. That's a big assumption to make that capital will immediately be there. So I would say it's not impossible, whether from the private sector or the public sector. We may find that gap could be filled in from other sources. But if you're running a company that's growing quickly, and right now you're getting investment from a UK-based VC fund or a UK-based growth capital fund, that's not a risk that you're going to be very keen to take. You're not going to be very keen as you're thinking about making your next round of investment into the business, as you're looking to take it to the next stage. You will not want to be making those plans on a wing and a prayer and hoping that the indigenous local VC and private equity community will be able to fill in the gap that has been left by the departure from your market of UK-based managers. I mean, there is a reason to be optimistic here. There's no fundamental reason why a UK-based private equity or venture capital manager would not be allowed to continue to make investments into EU27-based SMEs. That's FDI. FDI, generally speaking, is a freedom that is protected not just within the EU, but with third countries as well. So there is reason to think that those flows of capital from managers to businesses should be allowed to continue from the UK to the EU27 and vice versa. Even if the UK is no longer bound by the EU treaties, it's difficult to imagine that the UK is going to start to introduce restrictions on EU27 venture capitalists or private equity managers backing businesses in Britain. So there is a reason to be optimistic about that. But it's more over the medium to long term, I think, that the concerns should arise. If those UK-based managers that have traditionally raised money in the EU27 are no longer able to do so, do the links that have been created between the UK and continental Europe start to fracture? Because those are links that will fracture in other respects. The flow of people will start to be impeded. That's a great way of generating investment opportunities when people are collaborating on projects. The flow of scientific research collaboration is potentially going to be impeded and impacted. So as Rick said, as you put all of these impacts together, it's not difficult to imagine a scenario in which over the medium term, we are finding it less likely that managers in one part of Europe are investing in companies in another. But it's not inevitable. There are definitely things that we can do, both as the industry and things that government can do to make sure that that risk doesn't materialize. But we have to be conscious of the fact that Brexit is creating a set of risks that don't exist at the moment. And if we get the Brexit negotiations right, we can reduce those risks, we can minimize those risks. But I don't think there's any doubt that any deviation from the status quo, which is what Brexit implies, raises the risks beyond where we are today.
Thank you very much, Michael. By the way, at the end of the session, I will ask you, I'm giving you time to think about it. I will ask you what your recommendation to policymakers and Brexit negotiators and politicians would be to get the situation as right as possible. What should they achieve in the next year and a half so that the economy keeps on going, being financed properly? Eric and James, I'd like to dig deeper into the clearing of euro-denominated products issue. It's a big issue, we've summarized it already, but we need to dig deeper. Where would you strike the balance between the two sides of the arguments that we mentioned, that is efficiency versus financial stability? Is there more distinctions to be made? And here again, what can we tell negotiators? What can we tell regulators so that they do something that makes sense for everybody, for the economy, and for, and that's my idealistic, dimension, both for the UK and the EU, because at the end of the day, we live in the same part of the world, our interests are linked, so it is nobody's interest to get the solutions wrong. So what would be your advice on euro clearing to strike the right balance once we've said that there are valid arguments on the two sides? Eric, do you want to kick off?
Thank you. First of all, I think the clearing situation is in some ways a microcosm of what we just heard described with the market mechanisms more broadly. The EU post-Brexit will simply be a less efficient place. The EU is greater than the sum of its parts. We have a single market that allows for the free movements of goods and services and peoples, and that's a tremendously efficient way of doing business and tremendously efficient way of allocating capital, allocating resources. And with respect to the financial services market, a significant amount of that is currently concentrated in the UK. In the UK for efficiency reasons, for network reasons, and carving the UK out of that and reallocating part of those services to the EU. I mean, your question was, why can't those teams simply work out of the EU? Well, the answer is they can, and they will. But the loss of network effects will simply mean that there will be less efficiency there will be less mutualization, there will be less resiliency, there will be less cross-fertilization. The EU simply will be a less efficient place. How does that read across to the clearing environment? Well, let's take a step back. First of all, I think the most important way to look at the clearing debate is first and foremost over clearinghouse supervision. We have a framework, a legislative framework for clearinghouse supervision, which is laid out in EMIR, which gives the European supervisors authority over all the financial market infrastructures in the zone, and it allows, for instance, the ECB, which has authority over Euro matters, to have insight into clearinghouses outside of the Eurozone via the accords that it's drawn up with the Bank of England and through the EMIR legislative framework. Post-Brexit, all that disappears. So post-Brexit, there is no longer a framework for the ECB to have oversight or insight into the impacts of clearinghouses in London that are active and have a systemic impact on the EU financial system. And the same goes for ESMA. ESMA has no jurisdiction over clearinghouses post-Brexit, neither does the ECJ. So there is, as of April 1st, 2019, a legal vacuum. And I think that is the very first thing that we should be concerned about, and that I think is being addressed through the European Commission's proposal, is how do we look at supervision of infrastructure that is systemic to the EU financial system post-Brexit? Because in the current environment, the only mechanism that the EU has in EMIR is via recognition. Recognition is, as currently designed, not a very efficient cross-border tool. It effectively looks at the comparability of the regimes, and if the regimes are deemed to be comparable and the third country regime is recognized as equivalent, then largely supervision is delegated to the home regulator. Now, from a financial stability perspective, when you look at the issue of clearinghouses in London, which clear significant amounts of euro.
If I may, can you in 2 words explain, I'm not sure everybody knows exactly what delegation is about.
What?
Can you explain, just to make sure that everybody in the room understands and knows what delegation is about?
Right, okay. So, so currently, for instance, if we look at clearinghouses in the US, which have been recognized after a long and arduous negotiation, has been recognized as equivalent to EU rules under EMIR. What that effectively means is that supervision of the third country clearinghouses, so US clearinghouses in this case, which clear significant amounts of euro derivatives, the supervision is entirely left to the CFTC in this case to ensure that the risk management of the CCP is sound, that appropriate collateral segregation measures are in place, that the right margining processes are in place, and so on. The reverse is not true. So, for instance, EU clearinghouses that offer services to US clients, the US regulators supervisors don't rely on EU supervisions, they have direct supervision. So typically LCH, ICE, and others are actually registered as derivatives clearing organizations with the CFTC, and the CFTC has direct supervision authority and can send teams in to inspect. That doesn't exist under the current EMIR framework, and that I think leaves an uncomfortable loophole or lacuna post-Brexit, because currently 95% plus of euro-denominated swaps trading takes place in the UK, which is still part of the EU, so that there is a framework for supervision. Post-Brexit, suddenly 95% plus of euro-denominated swaps trading takes place in a third country, with no ability for ESMA or the ECB to have any insider supervision over what goes on within that clearinghouse, which, if it comes into a stress situation, can be meaningful in terms of stress contagion to the EU. So there's a very real systemic risk there that needs to be addressed. And the purpose, first and foremost, of the EC proposal is to put in place the tools for some form of enhanced supervision by EU authorities, by ESMA first and foremost, but with the central banks of issue contributing to that, in order to have an enhanced and shared supervision of those third country CCPs, where those CCPs are meaningful to EU systemic risk. So when I say it's important to look at the legitimate interests from both sides of the debate, this isn't about angling for commercial preference post or advantage post-Brexit. This is an issue of ensuring that that supervisors have adequate insight into market infrastructures that are systemic to their monetary zone. And I think that's a very important impact. And also, not just in terms of systemic stability, but also in terms, and you mentioned this earlier, in terms of the transmission of monetary policy. Significant amounts of euro-denominated repo are cleared in clearinghouses in the UK, and that is a market which is a fundamental part of the transmission of ECB transmission of monetary policy. The ECB, naturally enough, wants insight and control over that process. So I think it's important to work your way through all those things. Now, the flip side of that, as a number of commentators have been alluding to, is that, and I think you were asking earlier about what's our preferred outcome. Our preferred outcome as market participants is to see some form of agreed framework over shared and enhanced supervision in order to allow infrastructures to continue to provide services to both the UK and the EU with a maximum amount of appropriate supervision, so that the authorities are confident that in a crisis situation, the stress issues will be appropriately addressed, with minimum disruption to industry participants in what we look at as the business as usual environment. I see you're dying to ask a question.
No. Yeah. Would you say that the European Commission, its proposal that came out on June 13, came up with the right proposal, the right balance? What would you say to Olivier Gerson, who will be with us in 40 minutes? Olivier, have you well done, you found the right balance, or should it be done differently?
So I think, broadly speaking, and we're still unpacking a lot of the Commission's proposal, I think broadly speaking, the Commission's proposal comes out in the right place. There was a lot of concern over whether they would directly move to a mandate for location policy. The text opens that up as a possibility, as a last recourse, but it's not the core of the text. The core of the text is about supervision, and it gives, I look at the text as a toolbox. It gives EU supervisors a range of tools to achieve their supervisory mandates in terms of getting appropriate insight and on-site inspection controls to CCPs that are meaningful to the European financial system. It requires systemic CCPs to provide undertakings that EU supervisors will be able to achieve those controls and will have that access. And ultimately, it provides that if for very systemic CCPs, it is not possible to achieve the appropriate degree of supervision to give EU supervisors comfort that they can adequately control the risks inherent in those third country CCPs, then the ultimate recourse is to say, well, I'm sorry, you can't provide those services to EU participants from outside of the Eurozone, from outside of the EU, excuse me. If you want to offer those services within the EU, you need to be established within the EU so that there is direct supervision and direct responsibility. And I think what that speaks to is crisis management. It speaks to the issues around recovery and resolution. Broadly speaking, enhanced supervision will get you to where you need to be in terms of the business as usual management of an infrastructure, because you will have broad insight over the rule books, over how collateral is segregated, over how margin is calculated. The real question will be, how do you manage the relationship between supervisors in a crisis so that decisions cannot be taken by a single supervisor that works to the detriment of the interests of another interested supervisor from a different zone. And I think that will be the difficult part of the negotiation.
Thank you, very interesting. James, do you share Eric's views, or would you put nuances or have different views on those questions?
Sure, I share a lot of what Eric has said, so absolutely. I'll perhaps just highlight three things. The first thing to say is, and these are the figures that appear in the AFME report, the split or the relocation of Euro clearing to EU27 will increase collateral requirements, will increase capital needs to support that activity. And I think the critical point is to say the collateral and the capital are required to mitigate, as it were, the increased risks resulting from the split of this activity. So I think that's one core element is, underlying this, there is increased risks. That's why you need the collateral and the capital. Perhaps the second point is I fully share Eric's analysis. The basic problem is that, until now we've had a common overarching legal, regulatory, supervisory framework, and Brexit clearly, destroys that overarching framework. So we do have a problem. We want to get the, as it were, the market benefits of an integrated market. We want to get efficiency. Systemic risk, supervisory concerns absolutely are important. We need to find a structure, a mechanism to, as it were, to deliver, to satisfy, to ensure that we minimize or we control the systemic risks that are out there. And this, I think, is a core challenge. What can we put in place as a new structure to ensure regulatory cooperation, alignment, supervisory exchange of information, so on and so forth? And I think that's a core challenge. Specifically on the Commission proposal, I think that's a very good step forward. So I think we can, we broadly welcome it. Clearly, I don't think it's the end of the story. There will be a story going on, in particular with relation to UK authorities, UK market entities. So, there will be a need for further discussions and further agreements. Clearly, we're a long way from a satisfactory outcome currently with respect to, as it were, creating this new replacement structure. And that's clearly work that's ahead of us. Just one final thought is that I think it's helpful not to look in Euroclearing in isolation. I think Euroclearing is important because it's a precedent. Whatever the solution for Euroclearing will impact other areas. And I just want to throw out there for kind of review and discussion one area which has some interesting similarities, and that is the area of securities settlement. Interestingly, today, most securities settlement in Europe takes place in the EU27. From a UK perspective, important UK-based markets, important UK-based securities markets settle in CSDs located in EU27, and clearly in EU27 we have the massive ECB Target 2 Securities project. So looking forward, it's not unimaginable to see that the UK will be exposed to systemic risk because a good part of its securities settlement activity will take place outside the UK. So from a UK perspective, there will be a need for some kind of regulatory supervisory framework. If we take that and put it into part of the discussion, I think it will be helpful with respect to the solutions we will need for Euroclearing.
Very good and very important point as well. Thank you very much. Time to open to questions from the floor. If you're willing to share ideas, ask questions. If you do so, I will ask you to present yourself before you ask the question and be brief, the usual request. Don't be shy, don't hesitate. While you start thinking about potential questions, and please don't hesitate to raise your hand. There are microphones that can circulate it the second you raise your hand. One question I'd like to come back on is, do you believe there's going to be, and I'm very down to earth here, increase of cost of capital for EU corporations because of Brexit? Will the cost of raising money, whether debt or equity, will increase for EU 27 enterprises post-Brexit?
Maybe I could start off. I think from what BCG heard through the interviews, because they did ask for both an equity and a fixed income perspective, whether particularly large corporates who do the most fundraising would be impacted by Brexit. I think most of them probably said not in a big way. I mean, a few were concerned about market liquidity after Brexit, but all the multinationals get funds from all around the world as it is. Not just Europe, they can fund partially in the States, they can get money from Asia. So I think the feedback that BCG heard is the disruption from ECM and DCM perspective is probably relatively minimal. I do think on the SME side of things, for the reasons we talked about earlier, I do fear that there is an increased cost of the SMEs, cost of capital, because it'll be clunkier to raise funds. As Michael said, you could still, nothing stops you from buying anything, but Brexit will cause clumsiness in marketing. So there'll be less alternatives available for the core equity, the private placement funding, and also the derivatives-related services, because, as the figures mentioned, the derivatives business at the moment is relatively concentrated in London. And I think one of the big questions is how that will all pan out in terms of how the banks readjust their business models.
Any other view on the impact on cost of capital? There's another microphone here.
I think for our industry, it's pretty clear that the costs of doing private equity and venture capital on a cross-border basis will increase. If you've got to create a subsidiary that's based in the EU 27 in order to be able to continue to fundraise using a passport, when you've previously done that with one office based out of London, that's potentially a significant increase in your costs. The question is how those costs are then distributed. Who bears them? Will it be the institutional investor, the pension fund, the insurance company that has to pay a higher management fee or has to accept a lower return? Will it be the fund manager that has to accept that they're just going to have to suck it up and bear that cost themselves? Or will it be the SME, the entrepreneur, who finds that the PE or VC investor is now striking an even tougher bargain as they're looking to invest in their company? I think at this stage it's still very, very difficult to tell. But we shouldn't assume that it will be the fund manager that will bear the cost. We shouldn't assume that it will be the pension fund, the insurance company, the institutional investor that will bear the cost. There's definitely a scenario in which the entrepreneur finds that capital is either harder to access or more expensive to access.
Thank you. Any other view on this question?
Yeah, I think we have to be a little bit cautious on extrapolating and projecting our problems as financial service intermediaries onto corporates and SMEs. I certainly agree that there will be some capital reallocation, and globally, as we said earlier, the markets will be less efficient. There will be more capital required for financial service intermediaries, and that will certainly have an impact on the availability of financial services as provided by the sector broadly, as individual firms either decide to disallocate capital to the EU, allocate capital elsewhere. But then I would expect also that by ricochet, EU entities and others will reallocate capital to those markets as they see opportunities. Ultimately, it's always very difficult to project the cost of capital for an industry or for a firm, and to pinpoint it as, this is the result of this regulation or that regulation or Brexit. We as an industry have often struggled to work out whether the cost of capital for banks has gone up or down due to financial re-regulation, on the basis that, in theory, we are a sounder, so our cost of capital should have gone down, but we haven't really noticed that. At the end of the day, my sense is, when you look at the cost of capital for corporates, at the SME level, I think you need to be very discreet in terms of looking at. You can't look at all SMEs as being the same. SMEs that are active in cross borders will find greater difficulties. Ultimately, will be the biggest impact on capital costs for corporates post Brexit will be how much risk does Brexit bring to their business model, because that will drive capital allocation decisions, and those that are more exposed to cross-border dislocations post-Brexit will find their cost of capital going up. And those that are more, broadly speaking, domestic and suffer from less demand wastage or less productivity loss will see fewer impacts in terms of cost of capital.
Thank you very much. If there aren't any questions from the floor, I'll give you 1 minute each, Institut Friedland being action-oriented, for one recommendation for Brexit negotiators in order to come up with the solution that makes sense for the European, including the UK economy post-Brexit, taking a general view. What's your recommendation?
I think our recommendation, based upon the BCG findings, is avoid cliff effects through a combination of grandfathering of existing contracts to eliminate disruption to the corporates, to consider some type of transitioning period or implementation period, however you call it. And the third thing is have policymakers, both in the EU27 and the UK, speak to their SMEs in their countries to hear exactly what they're saying.
Great. Rick, you've taken my first point. So absolutely, I think the cliff edge is really the critical priority. With respect to the cliff edge, I think really there are two elements. There's what needs to be negotiated. So a transition agreement, almost by definition, needs the two sides to agree on something. And clearly, let's say there is some element of risk that there will not be an agreement. Therefore, we have to be concerned. But I think the other element around the short term is the fact that the two sides can take unilateral action, so can take some steps by themselves to mitigate some of the cliff edge risks. So that is something which I think both sides need to look at now. So that's my key recommendation. Look at short-term actions, distinguish between what needs to be negotiated and what can be decided or taken effect unilaterally, and perhaps just to throw out, clearly at the same time, we also need a long-term vision as to what is, the future relationship, and then clearly we will need, once we have that long-term vision, we will need negotiations and agreements to, as it were, deliver it.
Thank you, James. Michael?
It's not very original, but I can only agree with what James and Rick have said. I think it's important, actually, that we do reiterate that grandfathering and transition arrangements are absolutely critical here. Over the medium to long term, I've got no doubt that my members and other parts of the financial services industry will be able to adapt to whatever new normal is created. But what you can't do is wake up on the 30th of March 2019 and no longer have the legal right to carry out your business. And so that's the one thing that has to be got right. We can navigate our way around every possible permutation of the medium and long-term relationship. What we can't navigate our way around, as I say, is waking up on that morning in March 2019 and simply not being able legally to carry out our business.
Clear message. Kevin?
And that's the absolute essence of the message, I think. The fact is, whether it's grandfathering, transitional arrangements, or some form of forbearance, we can't just basically stop the clock. And we've spoken this morning about hard and infrastructure problems like capital and systems and infrastructure. There's also a soft element here, software. Our people need to move. They need to move with their families. If everyone decided to up and go to any European city tomorrow, the environment, schooling, education simply couldn't withstand it. So we have to recognize the fact there's a human element here, and that human element requires a period of transition and a period of forbearance for both capital and the individuals involved.
We're nearing unanimity on the message, which is good. I mean, at least, we'll have a message to pass. Eric,
Actually,
do you agree?
Some differences in the message here.
Okay.
Because there's some subtle differences. There's a big difference between grandfathering and transitional messages, which Rick and Michael and Kevin have discussed. James was talking about damage control. James was talking about what happens if there's no agreement, and I think that is an important issue to be thinking about, because there is a very real possibility of no agreement, and in that case, there will be, you can't have transitional grandfathering agreements if there's no agreement, and it's very important for policymakers on both sides of this divide to be thinking about how do you handle unilaterally risk mitigation in that event. And I think that's a very important issue to identify ahead of time where are the risks to your system, to your financial system, but also more broadly to all aspects of the economy, so that you address that. Now, to your earlier question of, what would we recommend to negotiators to avoid that sort of outcome? Well, we as an industry have tried to bring facts to the debate, because this is very much an emotional debate. It's very much driven by, if this debate was decided purely on rational economic issues, we probably wouldn't be sitting here today. So the issue, I think, from our perspective, would be think very carefully about what your red lines are, and prepare your electorate for some of the hard concessions that will need to be made in order to get to some sort of agreement, because at the moment it's not obvious that there is an overlapping area for agreement, and concessions will need to be made in order to get to the agreement that we would all like to see.
Many thanks. This was fascinating to hear you all professionals bringing real experience and thinking into our debate. So let me thank you all.